Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, let's talk about one of the big stocks of the day in terms of volume as well as price action. Aarti Drugs is showing double-digit gains in trade after reporting Q1 numbers. The stock is up around 16% at this point in time. The Q1 API and formulation business did lift growth, but it was the margins which sustained at over 12% for the second consecutive quarter. To discuss this and more, we have with us Adhish Patil, the CFO of Aarti Drugs, joining in now. Adhish, hi, welcome to the show. Well, I wanted to start with the margin performance. It's coming at around 12.7% this quarter. You've maintained margins of above 12% for 2 consecutive quarters. You've improved it on a year-on-year basis, and that seemed to be the big point of contention for the past couple of quarters. Have input costs eased, and what is your guidance when it comes to margins now?
Yeah, so gross contribution is definitely improving as the raw material prices have gone down. So last couple of quarters, we had seen a heavy decline in the raw material prices. But because of that volatile scenario, we had to book a lot of inventory losses as well in the quarter of December and some bit in the quarter of March as well, but not so much in June. And so going forward, if the prices stabilize where they are, then definitely there will be more gross contribution expansion, which we are hoping. So our target EBITDA margins for a longer term is around 14.5–15%, which we expect to reach by at least by the end of this current financial year, in last quarter of this current financial year.
What about the top line itself? I mean, in the second half, you are expecting a couple of capacities to come on stream as well. And, you foresee some dermatology in terms of, that as a revenue contributor to you as well. You forayed into that space. What would the revenues of this year look like? You've earlier guided for 15% volume growth. Do you want to update that?
Yeah, so volume growth, even in the quarter one, we had done 18% volume growth, but that was mainly because the first half of last financial year was not that great. Definitely, we will try to maintain this kind of volume growth with new capacities addition in the second half of this financial year. But there is a rate negative variation as well of almost about 8 to 9% if we compare year-on-year basis. So overall, on a value basis, we hope that we keep crossing that 10% mark for current financial year on a value base. Means despite of degrowth in the prices.
Okay, so value growth will be 10% in FY24, but volume growth, any kind of ballpark range that you'd be looking at?
Yeah, so we will always target for 15 to 20% volume growth.
15 to 20%. Okay, got that. Can you break that up for us? Because the specialty business was a bit weak this time. It was down almost 20% year on year. Any improvement that you're expecting there?
Yeah, definitely. A couple of campaign-based products were not dispatched in this particular quarter. So that will come back, and we have seen that a lot of MNCs are also telling us that they have an inventory pile-up as far as the spec chem segment is concerned. So their volume offtake might remain weak for a quarter or two. But having said that, few of our contract manufacturing businesses are picking up. In fact, we were not able to supply a few of our clients because of labor shortages in the summer season. Now they are no more there. So definitely we see that spec chem will grow, and plus chlorosulfonation product is coming online in a bigger way at the end of August month. So that will also help in building up spec chem revenues.
Okay. Well, I was just reading a report with regards to key API prices. Adhish, I wanted your thoughts on it. The likes of PAP, azithromycin, there's an IIFL report which has indicated that it's corrected around 30% from peaks. Is that the case? And are you expecting this kind of price correction to probably continue? Do you expect it to stabilize? And what would it mean for your business, considering that you get 70 to 80% of sales from APIs?
Okay. So yeah, for few of the products, the prices have corrected, but then the prices have also gone up. Means it was more to do with the demand supply mismatch, why the prices went up, and not mainly because of the raw material prices going up. So in few of the cases, the prices have corrected that much. For our kind of product profile, if we see the price movement is not more than 8 to 9% with respect to last June 22 quarter. So it is not that heavy. And right now the raw material prices are also stabilized. If I compare June quarter with respect to March quarter, around 2 to 2.5% negative price variation was observed in raw materials. And if I compare the month of May and June, there was absolutely no decline in the prices. So my intuition is that the prices won't change. Here.
Just a quick last question from my end, Adhish. One of the concerns has been the debt on books, because if you look at it, it's only risen from, say, FY20, FY21. It stands at, net debt is at around 600 odd crores as of the previous fiscal ending. Where does it stand right now? What are the plans to reduce it?
Yeah, so on a standalone basis, the net debt is 505 crores, whereas on consolidated basis, it is around 590 crores, out of which approximately 46% is long-term debt and the rest is working capital debt. Working capital we can definitely improve upon by improving on the inventory days, because after COVID, our inventory days have always been more by around 10 to 15 days. So if there is a certainty in supplies, we can definitely target that those inventory days and reduce the working capital. So there the debt can go down. And even with the upcoming buyback and the upcoming projects, we don't foresee our debt to equity ratio go beyond 0.7 even by the end of this financial year.
Right. Adhish, quickly, just before we let you go, 600 crore worth capex is what you've lined up. How much could that yield in terms of overall revenue, and structurally, what could margins look like once all of this capex is effective in terms of utilization?
Yeah. So along with that, greenfield capex or brownfield expansions are also going on. So we were targeting to reach a consolidated sale of around 4,500 to 5,000 crores with all this capex coming into play, both at the formulation side as well and your standalone company API and Spec Chem business.
By when?
It might take 3 years because this year all the capex will get commercialized. So next year and probably by FY26, 27 we can see that much. FY27.
So will that put more pressure on your debt then?
No. So by the end of current financial year, as I said, that it won't be beyond 0.7 net debt to equity. So most of the capex will be done by this financial year.
Okay. All right. We'll leave it at that. Thanks a lot for joining in and, taking all the questions for us. The street definitely likes what they heard. The stock has been on a tear, up 16% after a very good set of numbers. Of course, certain pockets like the specialty business are under pressure, but the margin has improved quite a bit. Let's step into a quick break. On the other side of the break, Richard Jain of 5paisa.com will join in with some trading strategies. Do stay tuned in.